let's talk about the basis of assets in general. Much of the tax law deals with the taxation of assets. What happens when you sell them? And we talk a lot about that in part 1, and we talk a lot about it in part 2. Because selling an asset and recognizing the gain on that asset or excluding the gain on that asset can apply to taxpayers as well as businesses. So this is a very heavily tested topic, and you need to understand it, okay? In order to calculate gains and losses from the sale or other disposition of an asset, you need to be able to properly classify the asset first. There are 2 main types of assets, real property and personal property. Now notice I don't say business property anywhere here. Okay? There's 2 buckets. The first 2 buckets for assets are either real property or personal property. Real property is real estate. Okay, that's it. Real estate. Real property includes land and anything permanently attached to it. Examples include buildings, farmland, personal homes. The personal homes are going to be lumped in with this class as well. So anything that's attached to the land, as well as the land itself, like farmland or just raw land that you've purchased for investment, that's real property. Okay, so commercial buildings, residential rentals, and subsurface mineral rights. Now, I don't know if the IRS is going to test you about mineral rights, but they might test you on royalties. And a really common type of income that people can receive from their land is something like timber royalties or oil and gas royalties. It's not reported on the Schedule C. Usually it's reported on the Schedule E. And this would be like a situation where maybe you own, 1,000 acres of timberland and you're letting some other company, cut those trees, and then you receive a percentage of that, or you receive a royalty from that, or you have 1,000 acres in Texas or something, you own that property. Someone either discovers oil or gas, like natural gas or shale or something like that on your land. And then you can either sell those mineral rights. Those are called subsurface mineral rights. They're considered divisible from the land itself. Or you could sell access to them, and then another company will come in and pump the oil or mine the minerals that they find on your land or that you found on your land, and then you can receive a royalty from that. Now, usually those royalties are reported on Schedule E, not Schedule C. So it's ordinary income, but it's not subject to self-employment tax. Okay? Because usually when taxpayers are the owners of that land, they're not actually doing the work. They're not the ones out there pumping the oil themselves. They have a company come in and do it, and then the company gives them a royalty based on the amount of barrels that are pumped out of their land or timber that's cut, from their land. So they receive a percentage of what the company removes from that property. But those are royalties. And subsurface mineral rights are a type of real property. That's how it's classified. Now, personal property is everything else, anything other than real estate. Personal property includes furniture, equipment, vehicles, household goods, collectibles where you might just own them for personal pleasure or even for investment if you collect them for that. Stock, trademarks, cryptocurrency, and copyrights. The tax treatment of an asset also varies on whether the asset is personal use, business property, or investment property. Now, real property or personal property can be business use or it can be personal use, right? So let's say I have my personal home. That is personal use, real property. Let's say I have a business building or an office building that I rent to business tenants. That's business use real property or business real property. Okay. Let's say I purchase land and it's raw land with nothing on it, but I'm purchasing it as an investment. I think it's going to go up in the future. Then that would be investment real property. Okay. That's all real property. If it's land or anything permanently attached to the land, like a building. Now, personal property is anything other than real estate, and it can include stuff like intangibles, like stock and cryptocurrency. Now, personal property can be personal use, business property, or investment property too, just like real property can. Personal use, personal property would be something like my household goods, my furniture that I have in my house that I use every day, and household goods, anything like that. That's personal use, personal property. Okay. Now let's say we go to my office, my business office, and there's furniture in there too, like computers and desks and everything else. That's business use, personal property. Okay. And then lastly, let's say I hold cryptocurrency, or I own cryptocurrency or stock. Then that's investment property, but it's also personal property. Okay. Don't confuse the term personal property with personal use property. That's not the same. The term personal property is an accounting term. Accountants use it all the time. When you hear accountants say, oh, personal property or personal property, that's because it's something that's other than real estate. Personal use property is something that you use for personal use, like your own personal vehicle that you don't use in your business, right? Or furniture that's in your house. There's a unique distinction there, because when you have a loss on business property or investment property, those losses are deductible. But when you have personal use property, like your personal use vehicle that you just use, for commuting or to run errands or whatever, if you sell that car, then those losses are not deductible. Okay, so there's a distinction there when you actually do sell an asset. But know the difference between real property, which is real estate, and personal property, which is basically everything else other than real estate. Basis in general. Now, to calculate gains and losses when an asset is sold, you also need to understand the concept of basis. The initial basis of an asset is usually its cost. It's what you pay for it, but not always. And this is going to get trickier as we go along. Just trust me. There are instances where basis is determined based on the fair market value of an asset when acquired by the taxpayer, most notably with inherited property, that's the case, rather than its cost. Typically, this is when property is acquired by inheritance or sometimes by gift. Like if someone gives you something, then the basis can fluctuate then too, later when you actually sell it. So the basis of an asset may include sales tax charged on the purchase, freight in charges and shipping fees. Remember this, because freight out is not included in the basis. And this actually makes a difference when we're talking about something like inventory. The cost to actually ship an asset to you is included in the basis. Like, for example, if I buy, a computer that I'm going to buy for my business, I buy a computer and it costs $1,000. And then the cost of the sales tax is like another 100. And then the freight, the shipping is another 50. All of that gets added to the basis. You don't deduct those separately. It's basically like everything that you see on the invoice then, right? But some people think that these costs are deductible as a separate line item, and they're not. If you buy an asset, the sales tax and the freight in or the shipping charges to actually get that asset to you are included in the basis of the asset itself. So for example, if you buy a delivery truck from like CarMax and they have to ship it from another state, then the delivery charge to ship it as well as the sales tax on that delivery truck get added to the basis, and that all gets depreciated together. You don't deduct the sales tax and the shipping separately as an expense. That's not how it's done. Installation costs and testing fees, delinquent real estate taxes that are paid by the buyer of a property, and the IRS has tested about this particular concept in the past, on past exams. So I'm going to give you an example of that. The cost of any major improvements to the property, legal and accounting fees for transferring an asset, legal fees for obtaining title to a property. All of these costs will increase an asset's basis. The results of the adjustments to the basis will be the adjusted basis. So you have the initial cost of something like a house. You're purchasing, let's say, a rental property, and you plan to rent it out to business tenants. The cost of actually having the asset transferred to you, like you pay a lawyer to, do the deed or title fees or whatever to actually transfer the asset to you, those legal and accounting fees are added to the basis. You don't deduct those separately. They're added to the basis of the rental property. And then you depreciate those over time. but you don't get to deduct them as a separate expense. So all of these costs increase basis. They're not deductible as a separate expense, and they won't decrease basis. It's not, you don't subtract these. You add these to whatever cost you have, whatever the initial cost is. Okay, examples. Brad purchases a parcel of farmland for $45,000. A few weeks later, Brad is served with a lawsuit, paperwork by the ex-wife of the former owner of the farmland, stating that the sale was illegal. So this is a title dispute. Title disputes will increase basis when you have legal fees for settling a title dispute or for perfecting title. This is a legal term, and it has to do with like a situation where you buy property, you buy a house, or you buy land, and then some person comes out of the woodwork and says, no, this land is mine, and this was an illegal sale, and blah, blah, blah. Sometimes that'll happen, especially after a death. Right? The original owner of a property dies, and then the heirs or the beneficiaries of the estate are like haggling, and one of the beneficiaries or the heirs will think that they have the right to sell a property or a house, and then they sell it, right, out from under the nose of the other heirs or beneficiaries, and then one of the other beneficiaries will pop out of the woodwork and sue whoever bought the property, saying it was an illegal sale. And that's why it's always good to have title insurance. That's what title insurance is for, because then they'll step in and they will defend or perfect the title for you. They'll like give that crazy person some money. Generally, that's what happens, actually. They'll like give that person some money and make them go away. That's what they do. Okay. So Brad paid, but sometimes people don't pay for title insurance and they have to pay for a lawyer. And then if you do have to pay legal fees to perfect title or to settle a title dispute, you don't get to deduct those. They get added to the basis of the property itself. So you don't get a deduction for legal fees on the Schedule E when it's something like this, or the Schedule C if it's business property. It's just added to the basis. And then you have to depreciate it along with the basis of the property if it is business property. So Brad paid $7,800 for an attorney's services to defend the title, and he eventually prevails and the lawsuit is deemed frivolous. Legal fees incurred in a title dispute over real property are not currently deductible, but they do increase the property's basis. Therefore, Brad's adjusted basis in the farmland is now $52,800, which is the $45,000 original cost, that's what he originally paid for the property, plus the $7,800 legal fees to defend his title to the property. And then if he later sells that farmland and he has a gain, then he's allowed to reduce that gain by his basis, which is $52,800. It's not $45,000 because the legal fees increased his basis in the property. Example number 2. Paul purchases a new vehicle for $15,000. The sales tax on the vehicle is $1,200. He also pays a delivery charge to have the car shipped from a dealership in another state to his home. The delivery charge is $210. Therefore, Paul's basis in the vehicle is $16,410. It's $15,000, which is the actual cost of the car, plus $1,200, which is the sales tax, and then $210, which is the freight in. It's the shipping charge to get that asset to him. Example number 3. Gabe buys a house for $120,000. 4 months after he closes the sale, he paves the driveway. So this is considered a substantial improvement, and it'll increase the basis of either a personal residence, if it's your own home, or something like a rental property or a business property as well. So it's considered a substantial improvement. It costs $6,000. Gabe's adjusted basis in the home is now $126,000. That's $120,000 original cost plus $6,000 for major improvements. Depreciation. So I'm going to only go over this really briefly. Depreciation is an income tax deduction that allows a business to recover the cost or basis of property used in a business over time. Depreciation decreases the basis of an asset, usually over several years. Some types of property, such as land, cannot be depreciated. You never depreciate land, ever. Land is never depreciable, but buildings, and business assets are depreciable. So generally, if you have a building or a rental, then you depreciate it over time if it's business property. Most other types of tangible property, such as buildings, machinery, vehicles, furniture, and equipment, are depreciable if they're used in a business. Now, I talk a lot more about depreciation in part 2 for businesses. For part 1 of the e-exam, test takers must understand depreciation primarily in the context of residential rentals, because that's what affects individual taxpayers the most with regards to depreciation. I know you can have a Schedule C where you have depreciable items, but generally if they're going to ask you about depreciation, they're going to ask you on part 2, okay? Dispositions and holding period. In order to correctly report a taxable gain or a loss related to the disposition of an asset, now when we're talking about dispositions, we're usually talking about a sale. Disposition means you got rid of an asset. Usually that means it's a sale, and now you have to figure out the gain or the loss on that disposition. Assets can be disposed of in multiple ways. Like, for example, you could give an asset away. Like, you could give stock to a friend or a family member or whatever, and that's different than a sale. But generally, when we're talking about calculating the gain or loss on a disposition, we're talking about a situation where the taxpayer has sold the asset, and now they have to figure out whether or not they have a loss or a gain, and whether or not that loss is deductible, okay, typically. So a taxpayer needs to identify whether the asset is personal use or used for business or investment, because then the outcome changes, whether it's personal use or business use or investment. Those are all treated very differently. The asset's basis or adjusted basis, the asset's holding period, short-term property is held for 1 year or less. Long-term property is held for more than 1 year, which means at least a year plus 1 day. So 12 months plus a day, a year and a day. And we don't count it as 365, just so you know. It has to be 12 months and a day for it to be considered long-term property. And this is really important because when it's long-term, you get beneficial tax treatment if it's something like stock. You get long-term capital gains treatment. If it's short-term, then if you have a gain, it's just ordinary, which usually you try to avoid. It's better for the gain to be long-term gain, okay? Because that's when those maximum capital gains rates kick in. And then you need to know the proceeds from the sale. So you have to know the basis, what type of an asset it is, the holding period, and then how much the taxpayer made on the sale, the proceeds. The next unit covers the basis of real estate. Let's talk about the basis of real estate. The basis of real estate usually includes a number of costs in addition to the purchase price. You know, whenever you look at that HUD-1, when somebody's bought a home or a piece of property, it always has a bunch of like little costs on there, right? The notary fees, the legal fees, the title fees, everything like that. Most of those costs get rolled into the basis of the property itself. If the taxpayer purchases real property, such as land or a building, certain fees and other expenses are automatically included in the cost basis. The transaction might include real estate taxes the seller owed at the time of the purchase. If delinquent real estate taxes are paid by the buyer, those amounts must be added to the property's basis. So I want you to understand this concept. Real estate taxes are deductible as an expense most of the time. If you own your own personal residence, like this, the house that you live out of, your personal use home, and you have real estate taxes that you've paid, you get to deduct those on Schedule A, right? Real estate taxes are deductible on Schedule A. Now, if it's a rental property, then the real estate taxes are deductible on Schedule E. You get to deduct those as a current expense. They're deductible. The time when the real estate taxes would not be deductible as a current expense is when you buy a property. Let's say you buy land or a building, and the real estate taxes are owed on that land, and they're delinquent, and you have to pay somebody else's real estate taxes as a condition of the sale. Now, this type of situation is commonplace when you have like those distressed property auctions, you know, when the county takes a house or they're forcing someone to sell because there's a bunch of delinquent real estate taxes on that property. Then the buyers will come in. You'll have like buyers that'll be purchasing those properties for cash, and they'll get like screaming deals on those properties. They'll get those properties for a cheap price, but they have to pay the delinquent real estate taxes. That's part of the deal because the county wants their money. But if you do pay delinquent real estate taxes that you didn't owe as a condition of the sale, then that gets added to the basis too, and they're not currently deductible. Example, Sally sells Anthony her home for $125,000. She had fallen behind on her property tax payments, so Anthony agrees to pay $3,500 of delinquent real estate taxes as a condition of the sale. Because a taxpayer is not allowed to deduct property taxes that are not his legal responsibility, Anthony must add the property taxes paid to his basis. So Anthony's basis in the home is $128,500, which is the actual cost of the home, the price, plus the delinquent real estate taxes that he paid. Okay. And this would be true even if it was something like a residential rental or an office building like business property, and you purchase it, but you also have to pay delinquent real estate taxes because you're purchasing it as like a foreclosure or at a distressed property auction or whatever. And there's delinquent real estate taxes on that property that you pay as a condition of the sale, because the county won't let the title transfer unless those are paid. Somebody's got to pay them, right? And if you're the one that ends up paying them, then you can't deduct them. They get added to the basis of the property. Construction costs. If a property is constructed rather than purchased, the basis of the property includes all of the expenses of the construction. This includes the cost of payments to contractors, building materials, and inspection fees. All of those costs get added to the basis. They're not currently deductible anywhere. Demolition costs and other costs related to the preparation of land prior to construction must be added to the basis of the land rather than to any buildings constructed later. And this is important because you can't depreciate land. So demolition costs are not deductible, and they don't decrease basis. You don't deduct demolition costs. You add demolition costs to the basis of the land. And then any building that gets constructed on that land later is going to be separate. So demolition costs get added to the basis of the land, and they are going to be wrapped up in the basis of the land forever until the disposition of the building or the land at a later date, right? So if you have a situation where you have like an existing foundation on land and you want to tear it out in order to build your own building, you don't like whatever's on there already, or there's like some rundown house on there that you want to remove, then the demolition costs to remove that building or that existing foundation are added to the basis of the land rather than to any buildings that are constructed later. And those costs get tied up into the cost of the land forever until you later dispose of that property in a sale, in a fully taxable sale. Okay? Example, Diane pays $50,000 for an empty lot where she plans to build her home. She also pays $2,800 for the removal of tree stumps and $6,700 to demolish an existing concrete foundation on the land. So this is considered preparation of the land. Okay? These costs must be added to the basis of the land, not to the basis of the future house. Therefore, Diane's basis in the land is now $59,500. So it's $50,000, which she paid for the lot, and then $2,800 for the removal of tree stumps, and then $6,700 to remove the existing concrete foundation on the lot. Okay? That all would get tied up into the cost of the land. The basis of the land would then be increased by these costs. Basis other than cost. So if you have a situation where a person receives property in exchange for services, then that person must include the property's fair market value in their income, and this becomes the basis in the property. If two people agree on a cost for services beforehand, The agreed upon cost may be used to establish the amount included as income and the assets basis. This would be something like a barter transaction. And the IRS doesn't like barter transactions. They don't. They want you to recognize income from all transactions, whether they are made with money, like cash, or whether they are made by like a property exchange. Now, if you have a situation where someone is providing services in exchange for property, then they can agree upon a cost in order to make that exchange. Okay, and let me give you an example of what that means. Jeremy is a CPA who prepares tax returns for his longtime client, Marianne. Marianne loses her job and cannot pay Jeremy's bill, which totals $400. So he originally billed her $400, but she can't pay it because she lost her job. Marianne offers Jeremy an antique vase instead of paying her invoice. The fair market value of the vase is approximately $525. So the fair market value of the vase is actually just a little bit higher than the services that he billed her for. Jeremy agrees to accept the vase as full payment on Marianne's delinquent invoice. Jeremy's basis in the vase is $400, which is the amount of the invoice that was agreed upon by both parties before the barter. So this is a barter exchange. His basis in the vase is $400, but I want you to understand that that's what he has to recognize as income. Like if he files on a Schedule C, then he would have to report $400 of income as if he had received cash from her. Okay, in a barter transaction like this. Even though the vase is worth a little bit more, technically the $525, they had an agreed upon cost beforehand, which is the $400 invoice that he billed her. So he would report $400 of income from the sale of tax services, which is what he invoiced her. And then his basis in the vase is $400, which is the amount that he recognized from services that he provided. So if he later sells that vase, then he would use $400 in order to determine his gain or his loss from that sale.
The next video covers the basis of securities. Let's talk about the basis of securities.
Basis of securities. Now, this is the basis of something like stocks or bonds or cryptocurrency. A taxpayer's basis in securities is usually the purchase price plus any additional costs, such as broker's commissions and settlement fees. So if you have a broker's commission for purchasing securities, like let's say you have your own financial advisor or broker that's buying and selling securities for you or on your behalf, then the broker's commissions get added to the basis when there's a purchase of stocks or bonds. When taxpayers sell securities, their investment brokers should provide them with a Form 1099-B, proceeds from broker and barter exchange transactions, showing the proceeds of the sale. The IRS also receives a copy of the Form 1099-B. If Form 1099-B does not identify a taxpayer's basis in the sold securities, the taxpayer must provide this information from their own records. If a taxpayer cannot provide evidence of their basis in an asset sold, the IRS may deem the basis to be zero. Okay, so this is important because in the past, the basis was not tracked by these broker exchanges. They didn't. The basis was not listed on the 1099-B. Ooh, that was fun. Back in the olden days when you had to like try to contact the taxpayer and say, what's your basis in these securities that you sold? Many times they didn't have it. Or you had to go look up historical cost and everything. This was not that long ago. I think the brokerage or the financial institutions had to start tracking basis like in 2010, something like that. But before that, there was no basis listed on the 1099-B. So it wasn't reported to the IRS, and the taxpayer themselves, the owners of the stocks, had to track that themselves, which of course many people can like barely know what's in their bank accounts. So you would have to track this information down. If they don't have that information, and many times they don't, if it's a situation where the stock has been held for a really long time, like they've held the stock for 20 years, or it's inherited from someone who owned the stock for a really long time, there will be no basis listed on the brokerage statement. Because back then, the firms didn't have to track it. It was the responsibility of the person who owned those stocks to track it. They had to track their own basis. So if the taxpayer doesn't have the basis, or they can't dig it up somewhere, then the IRS will deem the basis to be zero. It's their responsibility to track the basis, especially if it's something like older stock that's like grandfathered, where the financial institution doesn't have to track the basis anymore.
The next video covers the basis of property transfers in a divorce. In this video, we cover the basis of property transfers in a divorce.
Property transfers incident to a divorce. So the basis of property transferred by a spouse or an ex-spouse, if the transfer is due to a divorce, is the same as the spouse's adjusted basis. The IRS just considers it as if you are transferring, money or assets from one pocket to another. The basis does not increase or decrease. It's transferred. It's a transferred basis. Generally, there is no gain or loss recognized on the transfer of property between spouses or between former spouses if the transfer is because of a divorce. And it's not treated as a taxable sale, even if money changes hands. I want you to understand that. Like, if you have like a husband and wife and they own a house together, and then the property has increased in value, so one of them has to give money to the other one in order to retain the house. Like, the husband wants the house, so he says, okay, I'm going to give you $20,000 in order for me to keep the house, because the house has increased in value. And he gives her $20,000. It doesn't matter. It's not treated as a sale. It's just like as if he give her a gift that has nothing to do with the house. It doesn't increase his basis, and it's not treated as a taxable sale. She doesn't have to report it as taxable money, none of that. So when it's a divorce, or when it's spouses basically transferring assets back to each other, there's no recognition of loss or recognition of gain. You don't get to deduct anything, and you don't have to report anything. For property transfers related to a divorce, the transfer generally must occur within 1 year after the date the marriage ends. Now, this is just in the IRS pubs. I think you need to know that this is the IRS position. But the courts have allowed this type of non-recognition treatment years after the divorce has become final, as long as it was something that was outlined in the divorce decree. The courts have permitted this type of non-recognition treatment even if the transfer occurs, several years after the divorce. But the IRS wants you to finish up your divorce and transfer the property within a year. Okay, but the courts have allowed non-recognition treatment several years after the divorce became final. This non-recognition rule applies even if the transfer was in exchange for cash, the release of marital rights, the assumption of liabilities, or other financial considerations. And I'm going to give you a couple of examples. Danny and Abby finalized their divorce on January 23rd. So at the beginning of the year, their divorce became final. Danny owns a vacation home in Hawaii with a current adjusted basis of $285,000 and a fair market value of $550,000. So this is his house. He owns it. He paid $285,000, but it has a fair market value of $550,000. So it's increased in value over time. And Hawaii is not a community property state, which is why I'm using this as an example. It's his separate property that he paid $285,000 for. So Danny agrees to transfer his ownership in the home to Abby as a condition of their divorce. He transferred the property to Abby on December 12th. Since the transfer was made within a year after the divorce was final, there is no gain or loss recognized by either spouse, no tax reporting is required, and Abby's basis in the property is the same as Danny's basis before the transfer. So the basis transfers to her. And if she wanted to sell this house, then that's the basis that she would use in order to figure out her gain or loss on the sale. Okay? Example number 2. Andrea and Graham jointly own an antique collector Porsche that had a basis of $50,000 and a fair market value of $150,000. Now, this is different. This is something that they bought together. They bought this Porsche together, and the basis was $50,000. Half of the basis belongs to her, the $25,000, and half of the basis belongs to him. Now, they're splitting up property in their divorce, which happens many times. Like, okay, well, you get this property and I get this property. When they divorced, Andrea transferred her entire interest in the automobile to Graham as part of their property settlement. Graham's basis in the vehicle is the same as their original joint basis. So the entire joint basis will transfer to him. See, in this case, in the example number 1, this was his separate property that he purchased, and his basis transferred to her. This is a situation on number 2 on the bottom where it's a joint basis. They bought this property together. The joint basis transfers to him individually. And then when he goes and sells this Porsche, if he does decide to sell it, then his basis for determining gain or loss on the sale is going to be $50,000 as well. Okay? Not the fair market value. The fair market value does not matter in this case. And many times on the exam, when it's gifted property or when it's transfers incident to divorce, they will throw the fair market value in there to kind of confuse you or trick you. When it's a property transfer that's incident to divorce and spouses are transferring property as part of their marital settlement after divorce, the fair market value doesn't really matter. I mean, it matters to them, right? It matters to them while they're making their divorce settlement. But for tax purposes, it doesn't matter to the IRS. The basis is just going to transfer.
The next webinar covers the basis of gifted property. In this webinar, we cover the basis of gifted property.
The basis of gifted property. Now, this is the trickiest one out of all of them, is figuring the basis of gifted property. The basis of property received as a gift is determined differently than property that is purchased or inherited. The taxpayer must know the donor's adjusted basis on the property when it was gifted, its fair market value on the date of the gift, and the amount of gift tax that the donor paid on it, if any, if applicable. A lot of newer preparers, they don't understand how the gift tax works, when it's triggered. It's all wrapped up with the estate tax. That's the gift tax. It's not, the gift tax is not an income tax. It's a tax on the transfer of property. And if you have a person who is a very wealthy donor, that's the person who's giving the gift, then sometimes you will have gift tax in the mix. In general, no. But sometimes if you have a very wealthy person, then they will have paid gift tax on a gift that they're transferring. The concept of fair market value is important when calculating any capital gains tax liability on a gift. So it's important to know how the basis and the fair market value is determined. Generally, the basis of gifted property to the donee, that's the person who's receiving the gift. The donor is the giver, the donee is the receiver of the gift, is equal to the donor's adjusted basis. In general, the basis is going to just transfer. But not always. This is kind of tricky. So in general, it's a transferred basis. So for example, if a father gives his son a car and the father's basis in the car is $2,000, the basis of the vehicle remains $2,000 for the son. And the holding period of the gift would also transfer to the donee. That's important, especially when you're talking about gifted stock. So if I own stock and I've held it for a year and I transfer it to like my brother, like I'm going to give him a gift of stock and I paid $5,000 for that stock and I held it for a year and he gets that stock after I give it to him and he waits only like a month before selling it, then it's considered long-term to him because my holding period tacks onto his holding period. The holding period transfers as well as the basis. Okay? Now, this is a really confusing slide, but right after this, I'm going to give you some examples so that you can understand how this actually works with dollar amounts and stuff. Because this is like, I feel like this legal concept is really difficult to understand when I'm just explaining it to you, when I'm just reading it to you. But just listen to me, and then I'm going to give you examples, okay? In situations where the fair market value of the property on the date of the gift is less than the transferred basis, the donee's basis for gain is the transferred basis. However, if the donee, this is the person who received the gift, reports a loss on the sale of gifted property, where the fair market value of the property on the date of the gift is less than the transferred basis, his basis is the fair market value of the gifted property on the date of the gift. Just stay with me. Stay with me. The sale of gifted property can also result in no gain or loss. This happens when the sale proceeds are greater than the gift's fair market value, but less than the transferred basis in situations where the fair market value of
In this webinar, we cover the basis of gifted property.
the basis of gifted property. Now, then sometimes of stock. And explaining it to you when I'm in the transferred basis. His basis is the fair market value of the gifted property on the date of the gift. Just stay with me. Stay with me. The sale of gifted property can also result in no gain or loss. This happens when the sale proceeds are greater than the gift's fair market value, but less than the transferred basis in situations where the fair market value of the property on the date of the gift is less than the transferred basis. Okay, now this is why they say that gifted property is the worst of both worlds. Gifted property is the worst of both worlds because there are times when the sale of gifted property can result in no gain or loss, even though there is a loss, where the person who receives the gift, the donee, is not allowed to take a loss because it's gifted property. And I'll give you examples of why this is the way that it is. And this is just with gifted property. Inherited property is not like this. So this is when you have a living person giving something to another living person. Inherited property is a transfer after death. And a lot of times taxpayers will not understand this distinction. They'll come in and they'll say, oh, I got an inheritance. And you'll say, they'll be like, oh, I got an inheritance from my mom or my dad. And you'll say, oh, well, my condolences. And they'll say, oh, no, my mom and dad are not dead. And it's like, then it's not an inheritance. If someone is not dead, that's not an inheritance. That's a gift. If it's a transfer from a living person to another living person. Okay? Now let me show you how this works. Noah's aunt, Fatima, bought 100 shares of Fairway Airlines Inc. stock when it was $92 per share. Fatima's basis for the 100 shares is $9,200. So this is the aunt, and this is what she paid for this stock. Okay, this is her basis. Fatima gives the stock to Noah when it's selling at $70 and has a fair market value of $7,000. So it has lowered in value. She's not selling it though. She's giving it to him after it has dropped in value. If she had sold the stock herself, then she would be able to take a capital loss. But since she's giving it to him, she can't take a loss because she's gifting it to him. Okay? It's not a sale. In this case, Noah has a dual basis in his stock. He has one basis for determining gain and a different basis for determining loss. Now, here are three separate scenarios that help illustrate how the gain or loss would be calculated when Noah sells his gifted stock. Okay, scenario number one. This is if he holds it and then the stock goes back up again. If Noah sells the stock for more than his aunt's basis, he will use her basis to determine his amount of gain. So she paid $9,200. If he holds the stock and then he sells the stock for $11,000, let's say it goes back up again, then he will report a gain of $1,800. He's allowed to use his aunt's basis in order for determining his own gain. So it would be $11,000, his sale price, and then her basis, which was $9,200. So he would only report a gain of $1,800 on the sale if he were to sell it after the stock went back up again. Okay? This is probably the best possible scenario that could happen. Because then he gets to use her basis, and the holding period would be tacked on. So if she held the stock for more than a year, then he could treat it as a long-term capital gain. So this would be the best outcome here. Okay? Scenario number 2. If Noah sells the stock for less than the fair market value of the stock at the time of the gift, that's $7,000 in the example, he will use as his basis the fair market value at the time of the gift to determine the amount of his loss. Now, this is the worst possible outcome. This is a situation where the stock continues to lower in value rather than going back up. So she bought it for $9,200. When she gives it to him, it's selling at $70 a share. So it's $7,000. That's the fair market value when she actually gives it to him. But this is a situation where the stock has continued to decline. And then he eventually sells the stock for $4,500, which is even less than the fair market value on the date that she gave it to him. So he can only report a loss of $2,500, which is the $7,000 fair market value on the date that she gave it to him and what he actually sold it for. So the amount of difference between the $9,200 and the $7,000, that's lost. Fatima doesn't get to take it, and Noah doesn't get to take it either. This is bad. So they lose that amount. She doesn't get to take it, and he doesn't get to take it either. So his loss would only be $2,500. That's the most that he could claim as a capital loss on his tax return. Scenario number 3. If Noah sells the stock for an amount in between the fair market value and the donor's basis, then no gain or loss will be recognized. For example, if Noah sells the stock for $8,000, which is a little bit more than the fair market value when she gave it to him, but still less than what she paid for it originally, then there will be no gain or loss on this transaction. His basis will be deemed to be $8,000, exactly the same as his sales price. So if it's in between these two numbers, the 7,000 and the 9,200, when he actually goes, let's say it goes back up a little bit, but it doesn't go up enough that it's as much as she originally paid for it, then it's just treated as there's no gain or loss on the sale. He doesn't get to claim any loss, but he also doesn't have to claim any gain. Okay? So yeah, gifted property is the worst, is the worst of both worlds, because he doesn't get to take the losses that she would have gotten to take if she had sold it herself.
The next webinar covers the basis of inherited property. The basis of inherited property.
Now, the basis of inherited property is treated really differently than anything else that I just talked about. In most cases, the basis is the fair market value of the property on the date of the decedent's death, regardless of what the deceased person paid for the property or the adjusted basis of the property right before death. None of that matters. It's like the slate is wiped clean. So if I bought a rental property or a house and I bought it like in 1952 and I paid $10,000 for it and then I die and my children inherit that house and it's worth $500,000 on the date of my death, then that's their basis. The basis is the fair market value on the date of the decedent's death. And that's regardless of whether it went up or down. Okay, sometimes property value will go down, especially if you're not talking about real estate, right? So if I bought a car for $50,000 or $70,000 and then I die and that car, passes to my heirs, then, vehicles lower in value over time, right? So the basis would be stepped down. It would be less than what I paid for it. Whatever it is on the date of my death, then that's going to be the basis that's going to transfer to my heirs. In addition, when inherited property is sold by the beneficiary, it is deemed to have been long-term. It has a long-term holding period, regardless of how long the beneficiary held it. So, for example, once again, let's say I die and my children inherit either a vehicle or a house, it doesn't matter how long I held it. Like, let's say I bought a car for $10,000 and then I die a week later, and then that car passes to my heirs. Then they sell it a week later. It's long term to them. It's long term. Inherited property is always long term, regardless of how long the decedent held it, when they bought it. None of that matters. Always has a long term holding period, regardless of how long the beneficiary held it. And sometimes in your software, there'll be like an override that says like this property is inherited, whatever. Sometimes software doesn't do that and they want you to put in a date. Then you could just put in a date that makes it long term. You know, it's more than a year ago, and that's fine. I mean, it doesn't really matter as long as you keep track of it in your work papers. But if it's inherited, it's always long term. Always, always. Doesn't matter when the decedent purchased the property or held it or anything. When inherited property is sold by a beneficiary, the gain will be calculated based on the change in value from the date of death. This usually results in a beneficial tax situation for anyone who inherits property because the taxpayer generally gets an increased or stepped up basis. So that's when we're talking about this. Generally, we're talking about real estate because real estate goes up over time in general. Not always, but in general, real estate goes up over time, and that results in a beneficial tax treatment for the heirs of the estate. And let me give you an example. Roseanne's uncle bought 300 shares of stock 10 years ago for $850. So this is his basis, the uncle. Roseanne inherited the stock when her uncle died. On the date of his death, the stock was valued at $9,000. So Roseanne's basis is also $9,000. This is a stepped up basis. Roseanne later sells the stock for $11,000. She has a capital gain of $2,000, and it would be long term. So she would get beneficial tax treatment. Plus, she can also use whatever the basis is or the selling price that it would have been on the date of his death. And you could usually, when it's something like this and it's inherited stock, the brokerage statement won't have a basis on it, but all you have to do is, find out the date of death of the person who actually passed away and was the original owner. And then you just look up the historical sales price based on the date of the person's death, and you use that. That's the basis. Okay. Now, a step down basis. Now, there are cases where this rule can work against taxpayers. So it's always the fair market value on the date of death in general. There's also the alternate valuation date, which I'm going to go over in just a second. But in general, it's going to be the fair market value on the date of death. Now, most properties such as stocks, collectibles, and bonds generally increase over time. There are also instances where a property's value drops, and this can create a step down basis. Example, Norbert purchased a home with cash in Connecticut 10 years ago for $240,000. His neighborhood becomes riddled with crime, and Norbert's home declines in value. Now, to those of you in Connecticut, I don't know if Connecticut is riddled with crime. I just picked that as a random state. So, let's just talk about his neighborhood. His particular neighborhood becomes riddled with crime, and his home declines in value because of that. Norbert later dies. On the date of his death, the home's fair market value was only $198,000. So he paid $240,000 in cash. Let's say he owns it outright, and it declined in value after his death. So Norbert's daughter, Nikki, inherits the home. Nikki's basis in the home is $198,000. This is a step down basis situation. But if she were to sell the home for $198,000, like let's say she inherits it and she sells it a week later and she sells it for that exact amount, she won't have to report any gain from the sale. It would be not taxable at all because she's selling it for the fair market value on the date of her father's death. It's never going to be exactly that amount. Sometimes it'll be a little bit less. Sometimes it'll be a little bit more. And then, of course, the heirs can choose to hold on to that property and use it as a rental or whatever they want. Sometimes they'll choose to do that. But if they sell the house, then they use the fair market value on the date of the decedent's death as their basis for the determination of gain or loss on the sale. Example number 2. Anson bought 100 shares of stock many years ago for $10,000. Anson dies and his daughter Haley inherits her father's stock. On the date of Anson's death, the value of the stock had plummeted to $5,000. So he bought it for $10,000, but then the stock dropped in value and it's worth only $5,000 when his daughter inherits. So Haley's basis in the stock is stepped down for tax purposes to $5,000. The stock continues to decline, and 6 months later, she sells the stock for $4,000. So Haley has a capital loss of $1,000. That would be $5,000 minus $4,000. So she would be able to take a capital loss on this. It's just that it would be limited to $1,000 because she can't use her father's basis because he died. So his basis is irrelevant. And she has to use the fair market value on the date of his death, which is $5,000. And then it continued to decline. So she sells it for $4,000. So she has a capital loss of $1,000. Long-term capital loss of $1,000. The difference between her inherited basis and the selling price. Alternate valuation date. Although the basis of an estate for estate tax purposes is usually determined on the date of death, a special rule allows a personal representative of the estate to elect a different valuation date of 6 months after the date of death, and this is known as the alternate valuation date. Okay. In order to elect an alternate valuation date, the executor of the estate has to file an estate tax return, which is the Form 706. That doesn't mean that there has to be estate tax or it has to be a taxable estate. It doesn't mean that the estate has to be above the filing threshold for estates. It just means that if the executor is going to choose an alternate valuation date, which is 6 months after the date of death, then a Form 706 has to be filed because that's where the election is made. So if a Form 706 is not filed for the deceased taxpayer's estate, the basis in the beneficiary's inherited property is the fair market value at the date of death, and the alternate valuation date does not apply. Okay. And we talk about this because the alternate valuation date affects the individual taxpayers that are inheriting the property from the estate. This affects the living beneficiaries of the estate. So it's something that would affect my Form 1040. If I inherited property, for example, from my dad. If my dad were to pass away and I inherited stock from his estate and an estate tax return was filed and the executor of the estate chose the alternate valuation date, then I would not be using the fair market value on the date of my father's death. I would be using the alternate valuation date, which is 6 months after the date of his death. The alternate valuation date is only chosen when it lowers the value of the estate, the overall estate. Like individual assets can, be higher or lower. The value can be higher or lower than the date of death. But the alternate valuation date is always chosen by the executor when it will lower the value of the estate. I mean, otherwise, why would you do it? You want to have a lower estate value in order to avoid paying the estate tax. And if you have no experience with this whatsoever, you don't know what I'm talking about, then watch the estate, trust, and gift webinars. But the alternate valuation date affects the living beneficiaries. So it would affect how I would have to report the gain or the loss on the sale of the assets on my return after I inherited property from someone else. Okay? And it's 6 months after the date of death. And the executor is the one that makes this choice, not any of the beneficiaries. The executor makes this choice, and they make this election on the Form 706, which is the estate tax return. Okay, next unit is Unit 7, which covers capital gains and losses.